What if I told you that the most aggressive, high-stakes intellectual property war on Earth right now isn't happening in the server farms of Silicon Valley, it's actually happening in the dirt of the American Midwest?
Yeah, which is not what people expect at all.
Right. Today, we are looking at a $610 million peace treaty that, honestly, it just completely rewrote the future of global agriculture.
Because the assumption, for most people is usually that physical farming, so seeds, tractors, chemical applications, is just this really slow, plodding industry. I mean, you plant the seed in the spring, you wait an entire season, you harvest in the fall.
Exactly. It's supposed to be predictable.
Right. The financial cycles are supposed to be just as predictable, but the data we are parsing today, it shatters that assumption completely.
It really does. Welcome to Talk Tickers. We were dissecting Corteva's full year 2025 earnings call and their 2026 guidance framework. Corteva trades under the ticker CTVA.
It's just for context.
Yeah. And for you, the retail investor trying to figure out if this ag, chemical, and seed giant deserves a place in your portfolio, well, we are stripping away the corporate jargon. We have a massive stack of sources here: the earnings release, the management commentary, and the underlying historical SEC filings.
The heavy reading.
All of it. Our mission today is to figure out how a company primarily known for moving physical bags of corn seed is suddenly exhibiting the financial characteristics and the margin expansion of a high-speed tech licensing firm.
Because the structural transformation happening inside this company right now is just intense. I mean, they are generating massive cash flows. They are undergoing a literal corporate mitosis by splitting a global enterprise in two, and they are leveraging their balance sheet to legally outmaneuver their biggest rivals.
It reads like a thriller.
It really does. But to understand the trajectory for 2026 and beyond, we first have to, lock down the foundational data of 2025.
Okay, let's unpack this. Let's get right into those headline numbers. Because management teams can promise the moon, but the historical data tells us if they can actually build the rocket.
Exactly.
So looking at the full year 2025 print, organic sales were up 4%. Now, in a vacuum, 4% top-line growth is steady, but it doesn't jump off the page. The metric that absolutely demands attention is the profit.
The profit was wild.
Operating EBITDA, so earnings before interest, taxes, depreciation, and amortization jumped 14%.
Yeah, a 14% profit jump on merely 4% revenue growth is the textbook definition of operational leverage.
Right.
In absolute terms, that translates to an increase of over $430 million, bringing their total operating EBITDA to $3.85 billion for the year.
That is massive. When profitability outpaces revenue growth by that much, you are manufacturing margin expansion. I'm looking at the historicals here. And Corteva's operating EBITDA margins just crossed the 22% mark for the very first time since they became an independent public company.
It's a huge milestone.
They expanded those margins by 215 basis points. And the transcript attributes this heavily to a, quote, price for value strategy in their seed business, where they successfully pushed through a 3% price increase year over year.
Let's actually break down the mechanics of price or value, because it is a phrase management teams just love to throw around.
Oh, yeah, constantly.
But in agricultural science, it requires actual biological proof. You cannot just raise the price of a bag of corn seed by 3% and expect a farmer whose own margins are incredibly tight, by the way, to just absorb it.
Laugh you out of the room.
Right. The genetics engineered into that specific seed have to mathematically guarantee a higher yield at harvest. If the farmer pays 3% more upfront, the crop has to yield 5 or 10% more bushels per acre just to justify the premium.
So the technology literally has to pay for itself in the field.
Exactly.
Which implies that Corteva's R&D pipeline is genuinely delivering stronger, more resilient crops. Because if the biology failed, the farmers would just trade down to cheaper generic seeds immediately.
Yeah, the switching costs are relatively low if the product doesn't work. The fact that Corteva sustained that 3% price hike across millions of acres proves the efficacy of their proprietary traits. And on the other side of their business, crop protection, which encompasses herbicides, insecticides, and fungicides, they didn't just rely on pricing. They actually saw a 5% physical volume gain.
The biological segment within crop protection really stood out to me in the notes. The transcript notes double-digit volume gains there. And just for context for the listener, we are not talking about traditional synthetic chemicals derived from petroleum.
Yeah, completely different category.
Right. Biologicals are crop protection products derived from natural materials. So bacteria, plant extracts, even certain minerals. They are highly targeted, they degrade naturally, and the regulatory environment globally is heavily incentivizing their use over legacy synthetics.
The biologicals market is growing exponentially faster than traditional chemistry. I mean, Corteva has aggressively positioned themselves to capture that demand, which, partially explains that 5% volume lift in an otherwise pretty mature crop protection market.
Yeah, that makes sense. I want to pivot to the balance sheet, though, because we have to talk about the sheer volume of cash this business threw off in 2025.
It was a monster number.
They reported $2.9 billion in free cash flow. And just to be clear, that is not total revenue. That is the cash remaining after all operational expenses and capital expenditures have been paid. $2.9 billion. It represents a $1.2 billion improvement over the prior year.
Generating an additional $1.2 billion in cash in 12 months requires fundamental structural changes to how a company manages its money.
Right. You don't just stumble into $1 billion.
Exactly. Higher core earnings obviously contribute, and they benefited from lower cash taxes, sure. But the primary driver was this really aggressive tightening of working capital.
The mechanics of working capital in agriculture are brutal, aren't they?
Oh, incredibly brutal. You have billions of dollars tied up in chemical inventory sitting in warehouses, and you have these massive receivables because farmers often buy their seed and spray on credit.
Right, promising to pay the manufacturer after the fall harvest comes in.
Exactly.
Yeah.
Management functionally squeezed the slack out of that entire system. They forced a much more favorable cash credit mix. They collected way more early prepayments from farmers ahead of the 2026 planting season.
Oh, wow.
By the time they closed the books in December, their net working capital as a percentage of sales was sitting 300 to 400 basis points lower than their historical average.
So they ran an incredibly lean operation, maximized their cash collections, and banked $2.9 billion. That sets a phenomenal foundation. However, and I have to play devil's advocate here, looking closely at the Q4 data specifically, there's an anomaly that requires some serious scrutiny.
The volume drop.
Yeah. I'm reading the Q4 isolated metrics, and organic sales for the final 90 days of the year dropped 4%. And even more aggressively, physical seed volumes were down 8% in that quarter. Wait a second. If 2025 was so great, why did Q4 sales drop with seed volumes down 8%? Is that a red flag? Because if you just look at the final sprint of the year, it looks like farmers suddenly stopped buying Corteva's seeds.
Yeah, a quarterly volume drop of 8% in a flagship business unit usually triggers alarm bells for institutional analysts.
Definitely.
But analyzing agricultural equities requires a totally different framework than, say, software or consumer retail. You have to decouple the financial reporting calendar from the agronomic reality on the ground.
Because the crops do not care that Wall Street needs a clean fourth quarter earnings print.
Precisely. First off, the baseline comparison is skewed. The fourth quarter of 2024 was an all-time record for Corteva, making the year-over-year comp exceptionally difficult. But the core mechanism driving the 8% volume decline was actually a calculated operational decision regarding logistics.
Okay, how so?
Management intentionally shifted a massive tranche of North American seed deliveries out of the end of 2025 and into the first half of 2026.
Wait, why intentionally delay recognizing revenue? If a farmer orders seed in November, why wait until February to put it on a truck?
Freight optimization and weather risk mitigation.
Ah, of course.
Yeah, moving millions of 50-pound bags of seed across the American Midwest in December and January is a logistical nightmare. If a blizzard shuts down Interstate 80, your inventory is stranded. Furthermore, if a farmer's storage sheds are freezing, they do not want to take early delivery anyway.
That makes total sense.
So by shifting the physical movement of those goods to late Q1 or early Q2, closer to the actual planting window, Corteva significantly reduces its freight costs and avoids weather-related spoilage.
So the demand did not evaporate. It just slid across the artificial boundary of December 31st.
The order books confirm this perfectly. On the call, executive leadership explicitly stated that their early order programs for the upcoming season are exceptionally strong. The farmer prepays are fully on par with the prior year.
Okay, good. I also noticed a geographical shift mentioned in the Q4 data regarding Brazil. They noted a timing shift for fungicide applications and their safrinha crop. For those unfamiliar, Brazil effectively has two major harvest seasons. They plant their massive primary soybean crop, harvest it, and then immediately plant a second crop, usually corn, in the exact same field.
Right. They call it the safrinha.
Which translates to little harvest, even though it has grown to become a dominant global supply source.
Yeah, it's not so little anymore. Because the safrinha planting window is so tightly compressed right after the soybean harvest, any weather delays in the first crop instantly cascade into the second. Weather patterns in South America slightly delayed the cycle, pushing the fungicide demand and some safrinha seed sales out of Corteva's fourth quarter and into different reporting periods.
So the foundation of 2025 remains rock solid. Margin expansion, incredibly tight working capital management, and $2.9 billion in free cash flow with demand fully intact for 2026. This brings us to the core narrative of this deep dive.
The catalysts.
Yes, a company hoarding cash is financially secure, but it's strategically stagnant. We need to evaluate how management is deploying that $2.9 billion to permanently alter their competitive positioning. And Corteva is currently executing two massive structural catalysts.
These catalysts represent a fundamental rethinking of the corporate architecture. The first is the active separation of the company. Corteva is untangling its physical operations to create two independent, publicly traded pure-play companies.
One focused exclusively on seeds, the other on crop protection.
Exactly. They're currently operating under the code name Spinco for the new entity.
Let's look at the actual math and mechanics of a corporate spinoff of this magnitude. They are targeting the fourth quarter of 2026 to finalize this split. Right now, they are conducting a global CEO search for Spinco. They are negotiating with credit rating agencies to ensure both new companies emerge with investment-grade debt ratings, and they are drafting the Form 10 SEC filings.
The strategic rationale relies heavily on the sum of the parts valuation theory. When a seed business, which generally commands a higher price-to-earnings multiple due to its sticky intellectual property, is blended with a chemical crop protection business, the overall corporate valuation often gets dragged down to a blended average.
By decoupling them, management is forcing Wall Street to value the seed business as a high-margin IP powerhouse, entirely separate from the cyclical, manufacturing-heavy realities of global agricultural chemicals.
Right. But severing the nervous system of a global enterprise carries a massive upfront cost.
It has to.
The transcript quantifies this. Management expects roughly $100 million in dyssynergies, because when you split a company, you lose your economies of scale. You suddenly need two separate HR departments, two discrete global IT networks, two distinct corporate headquarters, and two executive leadership teams.
They have thoughtfully baked $50 million of that duplicated cost structure directly into their 2026 financial guidance. So they are absorbing the pain up front. However, as massive of an undertaking as this spinoff is, it was arguably overshadowed on the earnings call by how they deployed a massive chunk of their 2025 cash flow.
Oh, the strategic masterstroke of the entire year. Corteva executed a $610 million payment to Bayer to resolve all outstanding litigation regarding seed freedom to operate.
I want to spend significant time unpacking this, because sending a $610 million check to your most vicious global rival sounds like a surrender.
It sounds terrible on paper.
Right. But in reality, it is the exact opposite. This is where we need to explain the concept of freedom to operate, or FTO, and why agricultural intellectual property is so wildly complex.
To understand the FTO landscape, you have to look at how modern seeds are constructed. You do not just invent a single genetic modification and sell it. Modern corn or soybean seeds are stacked. They contain multiple distinct genetic traits layered on top of each other.
Let's use a technology analogy to make the mechanics clear for you. Think of a modern seed as a smartphone. The physical kernel of corn is the hardware. The individual genetic traits, like a gene that kills rootworms or a gene that makes the plant immune to a specific herbicide, are the software apps. Corteva has incredible R&D labs developing cutting-edge apps.
But developing the app is only half the battle. You have to install it into the hardware. The biological method used to insert those genes into the plant's DNA acts like the smartphone's operating system.
Okay.
Historically, companies like Bayer, through its acquisition of Monsanto, held foundational patents on the dominant insertion methods and certain legacy baseline traits.
They own the iOS. So even if Corteva developed a superior proprietary app, they couldn't run it on their seeds without either paying a massive licensing fee to Bayer or risking a multi-year patent infringement lawsuit. Their best technological advancements were locked in a legal traffic jam.
The $610 million payment comprehensively eliminates that traffic jam. It acts as a universal cross-license and legal settlement. It instantly solidifies Corteva's unencumbered right to use all existing technology in their proprietary corn, canola, and cotton product portfolios.
Think of it like paying a massive upfront toll to unlock an exclusive express lane for the next decade.
That is exactly what it is.
They bought their way out of the courtroom, but more importantly, they bought speed. Let's trace exactly how this capital deployment accelerates our pipeline. By removing the legal injunctions, they pull the licensing timelines for their North American proprietary triple-stack corn technologies forward by 5 full years. They originally projected commercial licensing well into the 2030s. They are now guiding for 2027.
Accelerating a primary revenue stream by half a decade fundamentally rewrites the discounted cash flow models that institutional investors use to value the stock. The present value of those future cash flows just skyrocketed. And it also accelerates their third-generation above-ground trait platform.
To clarify the terminology for our listeners, above-ground traits are genetic modifications specifically designed to protect the stalks, leaves, and ears of the corn plant from airborne or surface pests like the European corn borer or the fall armyworm.
Right.
This is distinct from below-ground traits, which protect the root systems from soil-dwelling insects like the corn rootworm.
The Bayer settlement allows Corteva to commercialize their next-generation above-ground trait platform in North American corn by the end of this decade, pulling it forward by 2 full years. But the most surprising acceleration mentioned in the transcript involves a completely new addressable market.
The cotton market. Historically, Corteva was effectively locked out of licensing their proprietary traits in U.S. cotton due to this interlocking web of patents.
As part of the broader $610 million settlement, a technological exchange took place. Corteva granted Bayer a license to use their proprietary enlist weed control technology in cotton. In exchange, Bayer granted Corteva the opportunity to license their HT4 technology.
This instantly opens the gates. Corteva can now compete in a high-value commodity market where their presence was previously negligible. The CEO, Chuck Magro, put a specific dollar figure on this strategic maneuver. He stated that over the course of the next 10 years, the company models this single $610 million agreement will generate roughly $1 billion in aggregate earnings upside.
It's an incredible ROI. You deploy cash today to permanently lower your legal risk, accelerate your highest margin products, and unlock $1 billion in pure licensing earnings.
And licensing is the ultimate business model in agriculture.
Oh, absolutely.
Oh.
Once the staggering upfront R&D costs are sunk and the legal pathways are clear, the marginal cost of licensing a genetic trait to a smaller independent seed company is effectively zero. Every dollar of royalty revenue flows almost entirely to the bottom line.
Which perfectly transitions us to the most critical financial milestone discussed on the entire earnings call, royalty neutrality.
Yes. To appreciate the gravity of royalty neutrality, we have to look at the historical power dynamics of the seed industry. For decades, Corteva and its predecessor companies were net payers of royalties. They had to rent the foundational genetics from competitors to ensure their seeds remained competitive.
The music industry provides the perfect parallel here. For years, Corteva was like a DJ constantly paying expensive sample clearance fees to other record labels just to release a track. They were bleeding cash to their rivals.
Management's core multi-year strategy has been to engineer their own foundational traits, migrate their entire global seed portfolio onto those proprietary genetics, and then aggressively license those traits out to the rest of the industry. The inflection point, the moment where the royalty checks Corteva collects from other companies finally equal and then surpass the royalty checks they pay out to rivals, is defined as royalty neutrality.
Heading into this earnings cycle, the market consensus expected Corteva to achieve royalty neutrality somewhere around 2028. But because the Bayer agreement instantly erased massive future royalty obligations, and because their own out-licensing business is accelerating faster than anticipated, management announced they will hit royalty neutrality in 2026.
Achieving a major structural milestone 2 full years ahead of schedule is incredibly rare. The momentum on the income side of the royalty ledger is staggering. In 2025, they improved their net royalty position by $90 million, shrinking their net expense to just $120 million.
We have to spotlight the geographical engine driving this out-licensing revenue, Brazil. Specifically, the adoption curve of Corteva's Conquesta E3 soybeans.
Brazil is an agricultural behemoth, specifically dominating global soybean production. Corteva introduced the Conquesta E3 trait package, which offers broad-spectrum tolerance to multiple herbicides into the Brazilian market using a pure licensing model.
Right. They did not try to build the physical supply chain themselves. They act as the IP owner. They license the genetics to local Brazilian seed multiplier networks. These local companies handle the capital-intensive work of physically growing, bagging, and distributing the seed, while Corteva collects a high-margin royalty on every acre planted.
The strategy is executing flawlessly. They closed 2025 with mid-single-digit market share in Brazilian soybeans.
Yeah.
Based on their current order books, they project hitting mid-teens market share by the end of 2026.
That's massive growth.
They're doubling their penetration in the largest soybean market on the planet entirely through high-margin IP licensing.
It is the complete realization of moving from defense to offense. They stopped paying the iOS tax to Bayer in North America while simultaneously collecting massive royalty checks from local multipliers in South America. Okay, we have thoroughly analyzed the 2025 historical performance. We have unpacked the intricate mechanics of the spin-off and the IP patent resolutions. The final piece of the puzzle requires evaluating how management translates these structural advantages into their specific financial guidance for 2026.
Management provided a tightly defined framework. For 2026, they are guiding for an operating EBITDA range of $4.0 billion to $4.2 billion. The midpoint of $4.1 billion represents a 7% year-over-year growth rate.
For the retail investor focused on the bottom line, operating earnings per share, or EPS, is projected between $3.45 and $3.70. At the midpoint, that is also a 7% increase. However, the EPS growth isn't just a product of higher absolute earnings. It is being mathematically enhanced by a shrinking share count.
Capital allocation is a core pillar of their 2026 strategy. Management authorized $500 million in share repurchases, specifically targeted for just the first half of 2026.
When a management team aggressively buys back $500 million of their own equity over a 6-month window, it signals a supreme level of confidence in their forward cash flow generation, even while they are self-funding a $100 million corporate spinoff.
Speaking of cash flow, investors need to adjust their models regarding the absolute cash number for 2026. We discussed the massive $2.9 billion generation in 2025. Management was very clear that 2026 free cash flow will normalize to a 45 to 50% conversion rate of earnings.
We have to explain why the raw cash number drops even as earnings go up. The 2025 figure was synthetically elevated by that extreme working capital discipline pulling forward all those farmer prepayments. In 2026, working capital cycles will return to historical baseline averages, which acts as a mathematical headwind to cash generation.
Right.
Furthermore, the actual physical cash for the $610 million Bayer settlement officially leaves the bank account in early 2026, alongside the upfront cash costs for the SpinCo separation.
The underlying cash engine remains robust, but the absolute reported number will reflect those massive strategic investments. Now, analyzing the $4.1 billion EBITDA target requires looking backward to look forward. During their last major investor day, management laid out a multi-year financial framework culminating in 2027.
Yes, the 2027 targets. And with this new guidance, they are effectively hitting the low end of their 2027 EBITDA framework a full year early. To understand how they manufacture 7% earnings growth in a global agricultural economy that the CEO explicitly described as mixed, we have to break down the EBITDA bridge.
The bridge from $3.85 billion in 2025 to $4.1 billion in 2026 is built on what management terms controlling the controllables. Specifically, they have hard-coded $200 million in net productivity savings into their operating model for the year.
Squeezing $200 million of waste out of a finely tuned global supply chain is incredibly difficult. How do they actually execute that mechanically? Are they closing physical chemical plants?
It is a combination of network optimization and agronomic efficiency. On the chemical side, they were continually rationalizing their manufacturing footprint, shifting production of specific active ingredients to facilities with the lowest marginal cost, and renegotiating third-party logistics contracts.
Well, makes sense.
But crucially, on the seed side, productivity comes from the field. By utilizing advanced analytics and AI in their own proprietary seed production fields, they improve the physical yield of the seeds they grow for retail. Higher yields in their production network directly lower their cost of goods sold.
They need every single penny of that $200 million in operational savings because the macroeconomic environment is actively working against them. The transcript quantifies a massive $80 million headwind specifically derived from global tariffs.
The geopolitical realities of global trade directly impact Corteva's balance sheet. This $80 million penalty is heavily concentrated in their crop protection division, and it is primarily the result of tariffs levied on active chemical ingredients imported from China into the United States.
The global supply chain for agricultural chemicals is heavily dependent on Chinese manufacturing for the raw, baseline precursor chemicals. Even if Corteva formulates the final proprietary herbicide in a facility in Iowa, they are often importing the foundational active ingredients from Asia. The tariffs act as a direct tax on their raw materials.
They are absorbing an $80 million geopolitical penalty just to run their factories, but they are fully offsetting it by stripping $200 million of structural costs out of their own network.
That is the essence of manufacturing a margin expansion. Looking at the top-line revenue drivers in the 2026 guidance, they project total company pricing to be slightly positive. Seed pricing will continue its upward trajectory, proving that the price-for-value biological argument holds weight with farmers. But crop protection pricing is modeled to be down low single digits.
The pricing pressure in crop protection is fundamentally a supply-side issue, not a lack of demand. The global market, particularly Latin America and specifically Brazil, is currently flooded with generic chemical formulations.
When the market is saturated with cheap generic alternatives, the pricing power for premium brands deteriorates. However, Corteva's defense against this commoditization relies on their portfolio mix. The transcript notes that 2/3 of Corteva's global crop protection portfolio is classified as differentiated.
Differentiated products include complex, proprietary synthetic chemistry still under patent protection, and their rapidly expanding biologicals portfolio. Because these differentiated products cannot be easily replicated by generic manufacturers, they command a sustained 10 to 15% margin premium over the generic baseline.
There is also a fascinating macroeconomic shift happening in Asia that directly alters the competitive landscape in Brazil. During the call, the CEO highlighted a recent policy change by the Chinese government regarding the export value-added tax, or VAT.
China repealed the VAT rebate for chemical exporters. Previously, the Chinese government functionally subsidized the export of generic agricultural chemicals, making them artificially cheap on the global market.
By repealing that rebate, Beijing instantly drove up the underlying cost structure for every Chinese generic manufacturer trying to export cheap chemicals to Brazilian farmers. The cheap alternatives are suddenly much more expensive.
This creates a structurally constructive pricing umbrella for a premium, differentiated manufacturer like Corteva. The macroeconomic interconnectedness is profound. A bureaucratic tax adjustment in Beijing directly relieves pricing pressure for an American intellectual property company operating in South America.
That is the level of deep analysis required to properly value this company. Now, I want to challenge one specific piece of the 2026 guidance because it seems glaringly pessimistic compared to everything else we've discussed. Management modeled relatively flat seed volume for 2026. 0% volume growth in their most critical, high-margin division. If they have the best genetics, the best pricing power, and an unencumbered IP pipeline, why are they guiding for flat volume? I mean, management expects flat seed volume in 2026. Are they sandbagging us? Setting the bar artificially low so they can easily beat earnings expectations next quarter?
A surface-level reading suggests extreme conservatism. But if you analyze the underlying agronomy and the macroeconomic shifts in North American farming, the flat volume guidance is a highly realistic accounting of physical constraints. As the executive leading the seed business bluntly stated on the call, it's February. There's still snow on the ground.
Institutional analysts build their financial models in February, but the physical reality of farming doesn't begin until the ground thaws in April, and the decisions farmers make in April are dictated by crop rotation practices.
Exactly. Agronomic science requires crop rotation to maintain soil health. Because North American farmers planted a historically massive, disproportionate amount of acreage with corn last year, biological reality dictates that a significant percentage of those fields must be rotated back to soybeans in 2026.
The macro expectation is that several million acres in the U.S. will shift away from corn, and the financial mechanics of that shift are critical. A physical bag of corn seed generally represents higher volume and higher absolute revenue for Corteva than a bag of soybean seed.
So even as Corteva models continued market share gains against their rivals in North America, those specific share gains are mathematically neutralized by the overall shrinkage in the total addressable market for corn acreage.
Furthermore, we have to look at the intentional cannibalization of their physical volume metrics in Brazil. As we discussed, they are aggressively transitioning their Brazilian soybean strategy toward the Conquista E3 licensing model.
This is a vital point. When Corteva transitions from manufacturing and selling a physical branded bag of soybean seeds to simply licensing the digital intellectual property to a local multiplier, their reported physical volume metrics decline. They're literally moving fewer physical goods.
But making more money.
Exactly. Because simultaneously, their profit margins expand drastically because they are collecting pure royalty revenue without the manufacturing overhead.
The flat physical volume isn't a symptom of demand weakness. It is the calculated byproduct of upgrading their global business model from heavy manufacturing to asset-light, high-margin IP licensing.
When you synthesize all of these distinct data points, the $2.9 billion of 2025 cash generation, the strategic elimination of the Bayer IP roadblocks, the aggressive $500 million share buyback program, and the methodical extraction of $200 million in operational productivity, it forces a total reevaluation of the company's valuation framework.
Which brings us to the ultimate synthesis. We have dissected the history, the mechanics, and the forward guidance. Now, we have to deliver a clear, actionable verdict for the retail investor listening right now. Looking at the totality of the corporate architecture, the macroeconomic environment, and the financial modeling, what is the bottom line on Corteva?
The verdict is an unequivocal, data-substantiated, bullish signal.
I'm arriving at the exact same conclusion. For anyone holding or considering the stock, the core actionable takeaway is that Corteva has structurally evolved beyond a traditional agricultural chemical play. If your financial models value this company merely as an industrial manufacturer of physical seeds and plastic jugs of herbicide, you are fundamentally mispricing the asset.
The correct lens requires valuing them as a margin-expanding intellectual property powerhouse that generates staggering amounts of free cash flow, and they deploy that cash ruthlessly to secure their competitive moat.
They achieved royalty neutrality 2 full years ahead of schedule. They successfully flipped their strategic positioning from a tenant bleeding cash to rent foundational genetics into a landlord collecting massive, high-margin royalty checks from the global agricultural market.
And for investors seeking near-term momentum, the second half of 2026 is dense with massive structural catalysts. The execution of the SpinCo separation in the fourth quarter will force institutional markets to officially reevaluate the sum of the parts. And preceding that, the massive dual investor day scheduled for mid-September will provide the exact long-term financial modeling for both independent entities.
The $610 million Bayer settlement is the linchpin. It comprehensively de-risks the long-term trajectory of the stock. By erasing the overhang of patent litigation and securing an unencumbered pathway to an estimated $1 billion in high-margin licensing upside over the next 10 years, they have secured a structural advantage that compound interest investors actively hunt for. They pulled their most advanced, profitable technologies forward by half a decade.
They bought the express lane, and they possess the only set of keys.
Before we wrap up this deep dive, I want to leave you with one final, deeply provocative thought to consider. It is a topic management only briefly alluded to on the call, but it represents the most explosive, asymmetric upside potential in the entire agricultural sector.
The commercialization of CRISPR gene editing.
Precisely. On the call, the CEO highlighted a massive, imminent regulatory shift in the European Union. Historically, the EU has maintained the most stringent, restrictive, anti-GMO regulatory environment in the world. But they're currently finalizing a transition toward a science-based, practical regulatory framework specifically designed for gene-edited crops.
It is critical to differentiate modern gene editing from legacy GMOs. Traditional genetic modification often involved inserting foreign DNA from other species into a plant. CRISPR-style precision editing simply targets and adjusts the plant's existing biological code to specific natural defenses on or off.
And Corteva's R&D facilities are already years ahead of the curve. They've engineered a new multi-disease-resistant corn hybrid, which they refer to biologically as a disease superlocus, that looks, in their words, fantastic in the test fields. They are preparing to commercialize it within a year or two of that EU regulatory approval.
A single genetic edit that provides broad-spectrum immunity to multiple diseases, built natively into the DNA of the plant without requiring chemical fungicide applications. It is the holy grail of sustainable agriculture.
Here's the question you need to model out for your own portfolio. With the legacy legal hurdles permanently cleared, with a balance sheet throwing off billions in cash, and with the global regulatory environment actively shifting to favor their exact technological expertise, will the standalone Spinco seed company use their proprietary CRISPR gene editing pipeline to become the absolute dominant, inescapable agricultural licensing monopoly of the late 2020s?
It redefines the entire ceiling for their valuation multiple. You are no longer modeling a physical harvest, you are modeling a global royalty stream on the foundational code of the global food supply.
It turns out that slow-moving agricultural freight train we talked about at the beginning actually has a rocket engine strapped to the back. Thank you for joining us for this incredibly deep breakdown. Keep analyzing the data, keep questioning the mechanics behind the numbers, and we will see you on the next deep dive.